Hi friends, myself Subrata Mukherjee, and today I will do the theoretical discussion on cash flow analysis. Both cash flow statement and fund flow statement are prepared as per GAAP, that is generally accepted accounting principles. Earlier we used to prepare fund flow statement, but when we found that we are unable to analyze the final account, that is balance sheet and profit and loss account, we developed preparing cash flow statement. The working and principles of preparing both fund flow and cash flow statements are same. The only difference is that of presentation of the two statements. The sources and applications of fund are presented in fund flow statement, but in cash flow statement these sources and applications are segregated into three activities, that is sources and application of cash flow from operating activities, then sources and applications of cash flow from financing activities, and the sources and applications of cash flow from investment activities are presented in cash flow statement. The net cash flow from operating activities, financing activities and investment activities are added with the opening cash and cash equivalent to arrive at closing cash and cash equivalent. Cash equivalent includes purely short-term and highly liquid investments which are readily convertible into cash and which are subject to an insignificant risk of changes in value. Therefore, an investment normally qualifies as a cash flow equivalent only when it has a short maturity of say 3 months or less. By presenting the cash flow under different activities, we can have a better control on the performance of the business and will help in the decision-making process. What does the positive cash flow from operating activities indicate, or what does the negative cash flow from operating activities signify? If the cash flow is positive from operating activities, it implies that the business is operating above cash break-even point. If the cash flow from operating activities is negative, it means that the business is operating below cash break-even point. If the cash flow from investment activities is negative, it means that the firm is expanding and making investment in fixed assets. Whereas a positive cash flow implies that the firm is selling off its asset. If the cash flow from financing activities is positive, it implies that the firm is raising funds for expansion activities, and negative cash flow implies that the firm is redeeming its capital. Here I will present some situation and analyze regarding the nature of the firm and to study the life cycle of the firm. Pattern 1. When you have a negative cash flow from operating activity, negative cash flow from investment activity and negative cash flow from financing activity. If all the three cash flow from operating activities, investment activities and financing activities are negative, it is highly unusual pattern. The company may be using existing stock of cash to meet the requirement of operations, investments and at the same time repaying loans and making payment for interest. It is highly unstable pattern. Next is pattern 2. When the cash flow from operating activity is positive, cash flow from investment activities is negative and cash flow from financing activities is also negative. This type of firm generally are knowledge-based industries, and this type of firm is known as cash cow firm because the cash which is being generated from the operating activity, the firm is able to meet its investment as well as financing activities. Not only that, the firm is also redeeming the capital that has been borrowed by the firm earlier and which is no more required by the firm. So the company is generating cash from operations to meet its investment requirement and pay interest, debt and dividend to shareholders. It represents strong cash flow pattern from operations. The company may be growing moderately or it may be a successful company or a mature company. Now pattern 3, where the cash flow from operating activity is negative cash flow from investment activities is positive and cash flow from financing activity is negative. When the cash flow from operating activity is negative, here the firm is operating below cash break-even point. When it is having a positive cash flow from investment activities, it means it is selling off its fixed asset. And the cash flow from financing activity is negative, it means that it is redeeming its capital. This pattern is showing that the company is selling its long-term asset and investment and raising cash to repay the borrowings and to meet its requirement of operating activities. The company may be in a financial distress or may be moving towards sickness. Pattern 4, where the cash flow from operating activity is negative, cash flow from investment activity is positive, and cash flow from financing activity is also positive. It is also a highly unusual pattern. As per this pattern, a company is meeting the requirement of operating activities by raising cash, by borrowing, or by issuing share, and also by selling its assets and investment. Highly unstable pattern, something inherently wrong with the business model. Pattern 5, where the cash flow from operating activity is positive, cash flow from investment activity is negative, and cash flow from financing activity is positive. The company is generating cash from operations and raising cash by borrowing money or by issuing shares to meet its investment requirement. The company may be in late part of growth stage. There can be other different pattern, and you need to introspect and analyze about the cash flow from each activities, and you can also determine the nature of the industry where the firm belongs. The students who are viewing my channel, I would like to request you to subscribe the channel so that you can get the notification when I will release a new video. Thank you.